Okay, so last time we talked about foreign exchange exposure. We defined foreign exchange exposures. We were talking about how it can affect companies. And also at the seminar, we were talking about the level of my exposure because I was just exporting services to the US but not importing any hardware. So that's why I'm absolutely motivated in weakening euro and stronger US dollar, which is not the case as we were able to see. And also we built a wonderful vector autoregression and forecast to see that what are the expectations, and the expectations were quite opposite. But it's much better if we can see and assess what kind of exchange rates can be expected. So if we just remember the end product of last week's seminar was that, okay, for 5 years ahead, we have the following expectations. So futures markets on the Chicago Merchandise Exchange, at least they have a pricing for 2 years ahead, 2-ish years ahead. Also, there were expert polls collected by Reuters. The European Central Bank had this forecast. If we were just fitting on estimating a historical trend line, then we get this really simplistic approach. And also our highly sophisticated macro-financial vector autoregression forecast provided this. However, in many cases, while we are interested in worst-case scenarios, best-case scenarios, and something in between, and it's much better if we have simulations. So we can see that, okay, these are expected by experts, by market players, and everybody else, but simulations are easier to produce. And in this case, we can see best case, worst case cases, because at the end of the day, we just have to run a stress test. So how the company performs under good conditions and how the company performs under bad conditions. And otherwise, we can just choose whatever exchange rate we want if we don't want to run this stress test. So yeah, it can be 1-to-1, or it can be this other sophisticated approaches. Okay, and for that one, it's easier to open the newest version of Matlab. Now it contains AI, and it's terrible, but okay, they are happy. They had to develop this one for a long time to make this so terrible. So we don't care about it. Just sometimes if you can see strange writings, then this is the reason. And last week I also prepared GARCH forecast somewhere. A moment, please. Last week I had to make all these videos and all these topics, and this one maybe. Here is GARCH. Yes. So, how can we make simulations ahead and with different forecasts? So in this case, I don't have to build up everything from scratch. So I will just copy and paste and then start to proceed. Okay, so we need foreign exchange rates in US dollar, and do we have the source file for that? Foreign exchange rates in US dollar. Yes, we have it. This is exactly the same file, but we were using just another sheet of that one. So here we have many different currencies also denominated in US dollars. And yeah, and that one is the float one, because this is in the opposite direction. So this is the droid what I'm looking for, because this has the proper denomination. Sometimes Thomson Reuters, or nowadays Refinitiv Icon database, has this bug that you are saying that I would like to download all the currencies in US dollar denomination, but sometimes it takes the opposite. So it inverts all the exchange rates and you have no idea what, so you have to manually check from other databases that which one is the case and what are the bugs which can make your life beautiful. And yeah, so let's save it here, and after that Matlab starts to see it. So first of all, Matlab is free for you, so the university has all the campus licenses, and if you are just following the instructions here, you just have to sign in. For the sign in you need edu ID. Okay, now it sees that I'm here because I recently logged in, but you just need edu ID for that one, and for that one you just have to register at the website of the library or something like this, and after that you can install it. Practically you don't need Matlab for this course, because in the old times all the seminars were based on Matlab codes, but later I realized that it's much better if you are just moving everything to Excel, because it's much more graphical, much more visible for students. But we have the risk management, financial risk management class in the spring semester, and if you are registering there, then this is where we will work with Matlab, because there we can do also in Excel many things, not all of them, because once I had to teach in Georgia and they had only Google spreadsheets, so I had to type in all the functions for option pricing and everything, but that was a bit time consuming and a lot of errors. While in Matlab we have all the specific functions for option pricing and everything like this, or for bond valuation, so that's why. Matlab is an industrial software, so it doesn't look nice, but it has a really wide user base. So when I had to learn this, I was learning it from my friends who were physicists, and they just use this as an industrial software. And why did you rearrange this, my dear? Split document, no split document. Okay, so now I can see what I'm doing. So this is an industrial software, and that's why some people nowadays recommend R. They are doing similar things. R is free, but it has many dependencies. So if you would like to do something, you have to download a specific set of functions which was made by someone, but after that it has a dependency towards another set of functions, so you have to collect many things here and there. In the past it was full of bugs. Nowadays I can say that okay, now it's as stable as Matlab. So in the past that's why I did not want it to teach with R, because I had no idea sometimes that it's a bug or a student error, and it was 50-50%. So I did not like it, but the structure is the following. So if we have percentage marks before anything, then it's a comment, so it's green and it's not part of the script, just it's part of the documentation. So we have to read in this foreign exchange rates in US dollar XLS6, from Excel with this XLSRead command or function, and then all the outputs of all the functions are on the left side of the equation, while there is always the function name after the equation mark, and there are all the inputs, switches, and so on. So so this is where we were just creating the data matrix. Yes. Okay, this is the dates, so we don't care about them, but this is the data. This is the US dollar. As you can see here, we have no headers here because this is just a matrix of raw data, so it doesn't care about any style. They try to integrate tables, but I'm avoiding it. Then we have to define obviously the rows and the columns of each matrix. So rows are always the first coordinate, and the second one is always the columns. So here I'm saying that, okay, I need all the rows, so for all the daily, this is daily data. We can see it, but this is daily. Yes, this is daily data from the US. And in this case, we are just loading in everything from the data matrix, from the second column until the last one. And after that, we have to take the logarithm, we have to take the differential to create nicely standardized data sets. So we can see that now, instead of growing to somewhere, which one can mess up any regression models, now we have a plot which fluctuates around 0. So usually currencies are not doing much, but when they are doing, then they are highly volatile. So obviously this starts in 2000, and this is the 2008 global financial crisis, and this is, one of them is COVID, the other one is the Ukrainian crisis. So yeah, and also this one is the sovereign crisis in the Eurozone. So we can see that volatility increases. Sometimes not. Sometimes exchange rates are really calm. So this is what we would like to exploit today. Then let's select only the Euro US dollar column, which is the second. Is it? No, I rearranged everything, so now it's the first. Yeah, so in this case I'm just choosing this one, and then we can have these GARCH model estimations, and not other class. If we are opening the lecture notes, then we can see that what they are. So originally these GARCH models were developed because people realized that it's really good if you are calculating the standard deviation based on the entire data set to define the level of risk, because in finance risk is standard deviation, so how volatile the currency is, or the asset or something which is traded on the capital market. And obviously, if volatility, so standard deviation, is higher, then it means that we are less confident in the pricing of this asset. So if pricing is going up and down, it means that they have no idea what should be. Or if this volatility is smaller, then they have higher confidence. So it's always a good indicator for confidence in pricing. But as you were able to see, that this is changing in time. So sometimes exchange rates are changing a lot. Sometimes they are just sitting there and not doing much. Again, so that was the volatility. Well, this is just the changes, but we can see that it's time variant. So after many steps in development, a guy called Engel published one model which was quite useless. So after that, in 1988, another guy called Boleslav published this beauty here, which is useful. And this is the Generalized Autoregression and Heteroscedasticity model, or GARCH model, which is really nice because it describes that, okay, today's volatility, so the market's inability to price in things well, depends on the yesterday's ability, so a day before, or usually one leg is completely enough. So if you are just looking one day or 1 week backwards, and after that some noise is added from some kind of a probability distribution, so it can be completely random change or less completely random. So it can be normal distribution or studenty or something like this. And this is really nice because practically this beta is describing 90%. So if we had high volatility yesterday, then today's volatility will be also still high because of this 90% confidence coefficient here, which says that, okay, we will inherit yesterday's volatility, if it was high or if it was low, because we are just changing in really smooth steps based on this error term here. And it's really useful because since then people are still using it. So it was developed in the late 80s, and we were integrating it into value at risk models. We are integrating it into option pricing. It has many utilization, because this is not here, but also we can build up variance covariance matrices with that one, and after that we can even model the time variance of correlation between different assets. So we can see that how usually currencies have really strong correlation with each other, but if there is a shock, then this disappears for 1 month, 2 months, then after that they still have this relatively high or relatively strong correlation with each other. So it had this extension, but today we are moving into another direction. So 3 people, G, G, and R, developed the GGR GARCH because they realized that volatility increases or changes asymmetrically. So in many cases we can see that volatility in pricing increases if the price decreases. So for example, when we can see that stock markets are collapsing or going down heavily, then volatility increases much more because the price is going up and down. And it goes downwards, up and down, but still it's way more volatile. Except Swiss franc. In case of Swiss franc, we can see that if it's appreciating, so there is a risk avoidance on the market, so they are going into safe assets like gold or Swiss franc, then we can see that volatility increases in this case for the Swiss franc or the gold. I'm not sure about Bitcoin. Bitcoin is also a really strange animal. We had now it's quite an old paper from 2020 or 19, when we were checking also Bitcoin volatility to see does it behave like a commodity or so where it's volatility located between commodities, shares or bonds, and it was more volatile than commodities, obviously. So during the whole 90s, many people developed many different GARCH models. At the end of the day, nobody uses them anymore. Only the baseline, original GARCH, or the GGR GARCH, because they are simple, nice, and the others are too fancy, and we don't have much added value. Unfortunately, the built-in GARCH model is quite rubbish in the case of Matlab. So there is this really nice professor at Oxford University. He deserves to show his page because, yeah, he developed the MFA toolbox a decade ago, and still we can use it because this is way better than Matlab's own GARCH models. So it's really easy to load in because we just have to download it from the internet, and then we can have different GARCH model setups, but we don't need that. We just have to use the function here. So let's be aggressive. Let's say that, okay, we are using this asymmetric GARCH model when volatility increases, when the currency depreciates, or maybe appreciates, so we will see from the negative or positive value of this coefficient, but we will let this asymmetry happen, and we are looking backwards only with 1 day. This is completely enough, and also we are saying that this random shock is not just generated by a normal distribution, by practically random numbers, but we have more extremes than supposed to happen, because if we are checking foreign so if you are checking US dollar euro exchange rates with this beautiful distribution fitter, epsilon, yes, close, new fit, then you can see what is the main concern here. Yep, close. So, normal distribution suggests that we should have the distribution of the changes of the US dollar euro exchange rate, and all the empirical changes should be under this discrete line here. Oh, sorry, continuous, not discrete, continuous line here, which is nice around the expected. Okay, this we have way more lazy days than supposed to happen when it just fluctuates at 0, but around the expected value of 0 changes, we can see that, oh, normal distribution nicely describes what is happening with the currency. The problem is living here that at low probability regimes, we can see that, oh, only half the extreme changes should happen at this level, and the other half is just happening without considering that, oh, under normal distribution this is not supposed to happen. But after that, after this point, no changes are probable. So according to normal distribution, 1 cent depreciation is impossible. 2 cent depreciation is impossible because now it's at 0, and we can see that, oh, there are happily some days when still there were changes here, there, even there, and here as well. So this is the nightmare for risk management, because these are the things which are hard to model. So even euro US dollar, which is the statistically the closest to efficient markets, so we have the highest liquidity here, their statistical behaviors are also, or properties are the closest to efficient market, and still it's more crazier. So you can expect that what is happening in other emerging currencies. So that's why it's much better to fit or estimate skewed student distribution, because in this case it's asymmetric, so it prefers to go in one direction, and then it's more crazy. Or we can say fat-tailed, because at the tails of the distribution we have many errors and strange things. Then we can see, so these are the parameters. Again, this is not nice, this is industrial, so this is supposed to be the, okay, not Mr. Shepherd, so this is supposed to be the constant. The constant is 0, so you don't care about this. It's also, sometimes people are asking that how can I know this, that this one is significant. I mean, p-values, where do they are? In the background, Matlab calculates or estimates the p-values, but p-values are always significant here, so it provides us always the result which is nice and significant, so we don't have to afraid of what is happening there. And also here we can see that this is the beta parameter, so 96% of yesterday's volatility will be inherited by today's volatility. So if Trump was saying something yesterday and it creates a volatility in the exchange rate market, then it will be also inherited by tomorrow's market, and after that with decreasing relevance. But this is what we call as volatility persistence. So volatility is not just randomly appearing on the market. If it's there, then it stays there. If the market is calm, then it's really hard to make it wider. Okay, politicians can do it, but to stay it at high volatility is also hard to do so. And then we can see that all this non-random noise, so this heavy-tailed distribution, will just generate 3% of all the volatility. So yeah, this is hardly driven by past values. And this is what we can see, that this is the asymmetry. So right now it's positive. So it means that if euro starts to appreciate against US dollar, then the volatility increases in the currency a bit, just 1.2%. So not much, but we know that, okay, this is the preferred increase. And the last one, or the last two, is the student distributions parameters, which can be nice, but we don't care about them, so yeah, they are nice. Then we can have some measure for fitness. So if you would compare it with other models, then we would check the archaic information criteria, Bayesian information criteria that are nice or not nice. So we have to check the log likelihood, the length of the data set, number of parameters, and mostly that's all. But not today, because we have no alternate model to compare it. Maybe I'm not deleting, just making it invisible. Then after that we can select the best fitting model, but we have only one best fitting model. Then we have standard deviation, not sexually transmitted disease, this is standard deviation, so STD. And yeah, so in the outputs we have this HT, which is supposed to happen, this is the row in many mathematical books. If you don't have Greek letters, then you are using H, and that's why we have to take also the square root of this one, because this is still variance. So this is the square of the standard deviation, so that's why we have this here. Also, let's calculate the standard deviation of the data, because now you can see the added value. So if we would just use up all this 6,500 days to estimate that what is the standard deviation of the US dollar, what is the risk of the US dollar position, then we would say that, oh, it's 0.06 is the standard deviation. While at the same time we can see that, oh, this is nicely changing from day to day, and sometimes in 2008, obviously this is way bigger. So this is how hedge funds are going to default when they are underestimating what can happen with volatility. The most famous default due to volatility increase happened in 1998 when long-term capital management defaulted, because whenever the volatility increased globally by 1%, then they had to put in 100 million US dollars as collateral to maintain their derivative positions, while also they were responsible for nearly half of the global options market. So they had practically a market monopoly because this hedge fund was funded by people who got Nobel Prize for developing half corporate finance and half option pricing equations and the whole discipline behind that. So they had huge credibility on the market, but because of the East Asian crisis, then the Russian default in 1998, the volatility increased so much that they had no idea that this can happen. So that was the reason that after their bailout, because at least US Fed was able to bail out them, so they were purchased by a consortium of many different banks, like Citi. And after that, they were able to run the fund, the hedge fund, until they were able to close down the position. And at the end of the day, it was still profitable, just not for the original owners, because they lost the company during the consolidation. But as a result, people realized that volatility is a relevant thing, so nowadays we are combining it with option pricing and everything else, because we can see that this changes in time. And for our purposes, we can use it even better, because we can say that, oh, we already have the parameters, we know how this dataset behaves, so we just have to simulate ahead. So we just have to see that, okay, what happens if you are just estimating this model, because we know that it fits well for the last 6,500 days. So if you are just looking forward for 5 years ahead, then we know that approximately 250 trading days are meaning 1 year. So if you are just multiplying it with 5, so looking 5 years ahead, then we can just use this TARS simulate function, which is really useful because we already used the same function, just not the simulate. In this case, it was just estimation part. But now we can set this up with completely the same parameters what we were estimating, and POQ, lag values, and the error type, which is still a QT, so it's much more extreme. We will do this forward looking simulation, and after that we are doing it 100 times. So this is a Monte Carlo simulation, where we are just running the same model with the same parameters, but obviously with random numbers, and then we can see that what scenarios can happen. So I was talking way too much, so let's see. Obviously, from simulations to simulations, we will have differences in the results, but usually the range is quite similar. So what we have to do here is just to, it creates the simulated change, and also it creates the simulated volatility. Right now we don't need the simulated volatility, I can just kept it there, but we can just pick up the last known data. Oh, this is the second column. Yeah, so first column is the date. We don't want to add the simulations to that one, and the second was the euro. And after that we just adding the changes back and forth. And yeah, this is where we can screw it up. Why? Because at the beginning I also added logarithm to this, and we cannot do this. Or we should do also exponential changes, but it's easier to just remove the logarithm from here and then re-estimate everything, because in this case we can mess it up. Now we are doing this extension of the data set, and now we are the happy owner of this scenario. So we have 100 scenarios developing ahead individually, each of them, so they are not dependent from each other. This is not copula or anything like this. This is just individually growing. And okay, that one is quite aggressive. So in this case, euro loses most of its value, or in this case, US dollar loses most of its value. So obviously the extremes are here and we can ignore them. What we should not ignore is the outcomes. So the distribution of outcomes, because if you are just checking that, okay, what happens at the end of this simulation, then this is where we have that, okay, let's pick up the 5% probability, so the worst case scenario, this is the worst case, or the 95% probable data, which is the other side of the probability distribution, and what is in the middle, so what can be expected. And then we can see that, okay, now we can stress test our business plan with this 1.48 euro exchange rate. We can have this other one, which is quite terrible as well, so 0.63 exchange rate, and also we have this 1.7, which is the middle. We are checking the business plan with all these three cases, and after that we can be happy about this. So and also we have to do it not just for 1 year, but I have to collect you I have to pick it up where scenarios. So we need it for 5 years. So, and how does it look like? Sim data. Yeah, so these are column vectors. So 100 column vectors are located here and going downwards. And luckily, yeah, only the simulations are kept here, so it's good. So we need J. I just have to check it that does it generate a column vector or does it generate a row vector. This is flat, so this is a row. Good. Then 1, 2. 1, 2, 3. So from first column until the last one. And then we just have to say that for each year, so for year equal 1 to 5, because we have 5 years ahead, and go away for then we not just picking up the last one, we have to pick up J multiplied by 250, because this is the end of the first year. If it's set to 1, then if it's set to 2, because it the J will go from 1 to 5 until it reaches the end, and then it goes to next level. So let's check it that if I'm setting it to 1, then what just happens? Yay! It's picking up the first year. And hopefully, can you feel it with scenarios? Yes, it starts to put the data here. So after that, we are just running this for cycle for 5 times. And then we have all the scenarios. And after that, this is highly useful because we can save it for our simulation. Simulation? Case study. Yeah, it's also simulation, just... Okay, so in this case we can see that euro strong, euro weak. This is the middle, or expected. Scenario, so these are the GARCH simulations. And after that we can see that first year, second year, and so on will be here. So we can see that obviously, since this is simulation and it goes sideways, so as time passes we have more and more extreme values here in the extreme part. Also here in the weak segment we have also deviations from the expected, so it should increase because this is how the math works here. But in the expected, still it's around the historical line of the exchange rate. So here we can see that, yeah, this is boring. So mostly it's fluctuating around the same value. That's why it's expected. So yeah, I'm also adding this beautiful line here because obviously this will disappear when I will running it again. So let's save it that we can prove that we were working on this one. But anyway, so I mentioned that, okay, it changes from time to time, from simulation to simulation. So if I'm just doing it again, will it change much? Not so. So it's 1.2. Okay, now it continues with 3 instead of 1. But still, at the end of the day, it's 1.45, 1.48. So the deviation will be not much. So it's still fluctuating around the same extremes. Okay, it's here. It's not ramping up so fast. So reaching 1.3 or 1.4, this one is slower. But here we have even more aggressive depreciation. So for stress testing, it's really good because if the company survives under these conditions, then we can see that okay, we improved much. And this is only, so that's the sole purpose for stress testing. Otherwise, we can use the this exchange rate, and after that it will be good. Okay, so this is one of the applications, and also before I forget, let's save this, not in the MFA toolbox but into our simulations and options. So that was one application. So that was second point. Then let's have the third point, which is option pricing. So if we are going back to the lecture notes, all these things are, so the documentation, you can find it here. Sometimes I'm changing a code back and forth, but it doesn't have much influence. So in case of option pricing, we just have to evaluate that what is the probability of changing the exchange rate above the threshold level, because in case of an option, we are buying a right to purchase or sell an asset at a defined time at a defined exchange rate. So that's all the contract, and that's why we have to define the time until the expiration of the contract. Obviously, if time is longer, then the contract will be more expensive. It depends on the volatility, because this is the risk, what is happening with the exchange rate. And since we are currencies, then that's why the interest rate differential will be a factor here as well. So how these interest rates are behaving, and also the targeted exchange rate matters as well. And otherwise we can see that this is just high school math. Okay, only with the exception that we have to fit in or estimate it to a normal distribution. So from normal distribution table, we just have to find that what is the value in normal distribution for this number, and then otherwise we can do it relatively easily. So we have all the data, not here, but in the here, because we have the, I recovered this bug. So we had the sovereign premium data, which is exactly this difference, but for the function we have to give the individual ones. So we have to have, this is for the US, and this is for the euro, and we have the exchange rate, and this is a proper exchange rate with good denomination. So maybe I'll just copy these three things because we don't need the rest of them. Oh, we can add it here. For option pricing, oh, I deleted. So for option pricing, even we can find Excels which can do this Garman-Kolhagen modeling. So you just have to give that what is the volatility, what is the exchange rate, the target, and so on. And after that, it will just estimate. Okay, removed. But now this is mostly data. That's why it's nice if I'm just adding also the dates as well, because here we can see what happens. So we are just sitting there, and then it's much better if I'm just loading in the data again. Instead of calling you this way, also it's much better if you can locate it where we are right now. So change directory to this one, and then we'll pick it up. Okay, we don't need this anymore. No, just don't save it. Okay, so okay, this is the Excel sheet's name. And obviously we have to define the name of the sheet as well. So this is option pricing. Then I have to close it down because Matlab will not able to load this in if I'm sitting here. Please. Oh, I did not delete it. Anything. Please don't freeze. Now it has AI, but it cannot read in easily on Excel sheet because that part is difficult. Let's close this one. Yes. Worksheet is not going to be activated yet. And after that, I have to open both of you. Such reliability. No, come on. I was hoping that they will remove this bug from the newest version of Matlab, but as you can see, it's still there. That if you are using an Excel sheet long enough, then after that it's not able to read by any other programs. Yeah, so we can see that okay, data was loaded in. Then we just need the code, and here we have also a manual code for option pricing somewhere. But we don't care about it because Garman-Kolhagen option, it's way better if I'm not typing this one. So Garman-Kolhagen option is part of the search of the documentation and also the set of functions. And we have multiple of them. One is a simple one function model, and the other is a long one. It should be. Yes, this is the proper one. Yeah, so sometimes I have no idea why they are doing this. So we have the same function with this structure or with this one. So one line or multiple lines of defining dates and so on, and yeah, who cares? Nobody. Okay, because they are developing it, but nobody else. Okay, so we have to define the following stuff. Price of the exchange rate today. Okay, right now it has a meaning. So AI is coming up with something. Tab, yes. So strike price, rate, time, volatility. You don't want to do this. I have no idea what you are trying to do, but please don't. And then, because we know that volatility is an issue here, then that's why before doing anything, we are just estimating our GARCH model. But since we are expecting normal distribution, we could say that okay, maybe this is quite offensive to use student T distribution because they are coming from an opposite direction. But on the other hand, in this case, we are eliminating all the nasty stuff from the data set, so it's much better if you are just saying that okay, let's keep this one. Okay, so the data, first column is the exchange rate, second column is one interest rate, and the other one is the other interest rate. So this is the exchange rate. This is what we need here. So let's give back the logarithm because we don't need only returns here. So We are just estimating or happy, not so happy because y is not existing. So now you can see that this is the logarithmic return. Oh, this is just calculations, and then we can say now that, okay, price. Right now the price is the last known data. So data, and this is the last row and first column. So last known EURUSD exchange rate. Then target. If we would like to do a hedging, then practically we don't. So I would like to fix the exchange rate because I don't care what is the current exchange rate right now. I just would like to maintain it. I don't want to allow any changes in the future. So that's why we can say that, okay, let's fix the price. So the strike price 1 year later when the contract expires, then I would like to have this exchange rate what we have today. So eliminating all the exchange rate exposure. And you are so cute, but one variable is missing. Yes, this one. How nice is when you are not forgetting it. So, what is the exchange rate? Obviously not this 1%, and this is the domestic. I mentioned the exchange rate, no, this is domestic interest rate. So, risk-free rate, not example, this is, yeah. So first of all, I would like to convert my USDs in the future at today's rate. So this is completely hedging, and then the RD is the euro interest rate, but we should never forget that in percentages, because this is how we can this is how we can mess up that days are in percentage points, so we have to divide it by 100, because otherwise we will have a really expensive options. Okay, so data. Okay, this is the second column. RD. Also, let's give the RF. Yeah, and I mentioned it, and after that I forgot. So we have to divide it by 100, and this is the third. This is the USD, and then also we have time. So time measured in years. This one is correct, and then we will just define that. Okay, what happens if we are just increasing to 2 years, 3 years, and so on and so on. Today we are purchasing all the options 5 years ahead, and after that we will eliminate all the exchange rate exposures. And this is the volatility here. Here we can say that this is useless, but this is the square root of the variance at the last known. And this is only one column. So if we would like to be more precise, then with the simulations we can simulate also forward, and then we can add the simulated variances. But yeah, this is also good enough, so it can be accepted. at the last day. What is this number here? It's highlighting F9, and then we can see that, okay, right now the volatility is 2.4%, so it's not so much. And then after applying everything, then we have a call option fee, which is 0.3 cents for buying stuff, and also we have the put option fee with 2 cents to buy one sell one euro here, and then this is 2 cents. So now we can say that, okay, let's create again the for cycle for buying options 5 years ahead. So J equals 1 to 5, then you are J. We are just saving 1 to J here and 1 to J there, and now we are the happy owners of the call and put fees. Where should I put them? Maybe and then we are saving also the put. Option fee. Unfortunately, we have to pay everything right now, so it will. I already in losses in the first year, so I will be in even bigger losses. But after that, I can eliminate all the exchange rate risk for 5 years ahead. So this is quite overkill. And also we know that this is my target exchange rate. For all these options. So I will get I can buy US or euros for this exchange rates, and then for the next 5 years ahead. So this is quite expensive, but yeah. Now we can assess that do we want to do it or not, because now we have proper values connected to this one. But also, we can close Mr. Shepherd. There is the Heston option pricing. And the Heston option pricing is much more trickier because it not just considers that, okay, we have some kind of a volatility, so prices are changing, but also it starts to consider the behavior of this change. So what is the expected value of the volatility? What is the volatility of the volatility? What is the actual level of volatility? How fast can we go back to the high volatile levels, to the usual one? And also, what is the correlation between the exchange rate and its volatility? So are they supporting each other, or they are acting each other? So when the volatility increases, up and depreciation or appreciation. So that's why Heston is highly preferred nowadays, but also during the last decade. Unfortunately, the computation demand is bigger than this really simple black source based option pricing, but at least this is much more accurate. So that was the Garman-Kolhagen. So this one is simple, we can do it in Excel. The Heston is much more difficult. C point B. So we have 3 options, and one of them is fast, other 2 are really slow. And I never know which one is what, so let's pick this one. So you can see that otherwise this is also just one function. Okay, if it will be slow, then obviously this is the slow version. So yeah, no, we don't need this one. No. This is not the good one. And we don't want to have American options activated. This is already complicated enough. So. You are 0. Yeah, we need dividend yield as well, because otherwise we're not able to add currency representation. Dividend yield is R flatline D, flatline F. Yeah. So we have the Heston. Practically the structure is the same, so we have to define asset price. We know that because this one is from the last known value of the data. We have the strike price, which is the same as the asset price. We would like to freeze down the current exchange rate. Then we have the rate, which is the RD, so the interest rate. Euro. Then we have the settle date. Practically it doesn't matter, so we can give any dates, but okay, let's say that 2025, January, and 2026, January 1, and this will be a 1 year long option. So in this case, we can set up, fine-tune options much better, but yeah, it's good enough. And then we have to define also RF, which is the foreign interest rate, and then all the volatility data will come from the GARCH. So we just have to see which one is what. So we have the V0, we have the theta, V, kappa. At least we should switch to this one. So the theta is the expected value, and this is where we're just picking up the mean of the expected level of volatility. Kappa is the speed, recovery speed. What is your name? Reverting ratio, sorry. So how fast can we go back to the mean if it diverges away? Unfortunately, here only we have this Feller classification, which says that kappa should be bigger than a threshold. So I just added a small number and now it's bigger. But yeah, this is where we are just cutting some corners. Sigma B, then this is the volatility of the volatility. So we are just calculating the standard deviation of the standard deviation, and rho is the correlation between the return and the volatility. There you are. And yeah, this is the last known value of the volatility. So so in this case, let's just check it that, okay, is this providing meaningful data? So we were able to see that it's 2.35%. If we are just checking what is the expected value, then right now we are a bit under the expected value of the volatility. What is this reverting ratio? I don't want to do this because of why? Yeah, I mean it. Can you understand this one? What is your problem? Square root? Ah, okay. One bracket is missing from here. Now, can you see it? Yes, you are able to see it. Okay. Good. Then volatility of the volatility. Okay, this is the level of the fluctuation of fluctuation, and then we can see that how they are correlating poorly. So don't we have to set up? Yeah, that was the time. Okay, so we set up everything. Then please don't fail. Okay, it was not failing. So, with Heston, unfortunately, we have to do no way that we are doing it manually, so we are just taking the previous 4 cycle, and then we are just saying that, okay, 25 plus J. We are not working. And we can wait for cycles, but we need raw data, so it's that way. We can see that this is low, so it would be immediately done by the price. And I created that. Yeah, the original was good. when I'm too lazy to translate, transform them. Okay. Oh, Google GARCH simulations, they have to go down again. So let's do here. And this is my. Oh, this is good. Is it more expensive? Yes, it is, because obviously if we are picking up more and more parameters about volatility, then yeah, it will be representing everything. So Heston options are always more expensive than the more simple one, Garman-Kolhagen. We are also calculating the call fees. The target rate is still the same, so I don't want to modify that one. Just let's make it nicely shaped. So here we can see that also the call option fee is more expensive and the put option fee. So if you would like to buy an option, then let's hope that the seller will sell it with black source base, but if we have to sell or write out the option on the market, then obviously we have to do the Heston calculation. That's why it's popular, because in this case it represents way more risk, or money relevant risk components are included, not just saying that okay, this is a discrete number and it doesn't change in the future. Obviously that's quite stupid. So this is what we have here today, and after that tomorrow we will use this for calculation. So this is just an introductory stuff into risk management. When we are dealing with options, then these are the methods what people are using it, banks. So